So, why not try to get a better deal? The competition is huge. There are thousands and thousands of VC funds, a lot of, I would say, established or known funds have lost team members who are creating their own VCs, trying to go their own ways. And this is something that really makes an LP, puts an LP in a position to, why not? Let's try to negotiate better deals. And the bigger you are, more capital you are able to provide, it's better your negotiation points or arguments are stronger.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Damir on the program. He's a seasoned early stage investor, advisor, and private asset manager who's been operating at the intersection of high finance and early stage tech for a couple decades. He's the co-founder and CEO of G plus Quant. It's a London-based consultancy that bridges top startups with global venture capital, LPs, and family offices. Beyond investing, Damir's journey spans asset management, trading, blockchain, even Freemasonry. I think I know what that is. We'll dig into all of it. Thanks for coming on, Damir.
Thank you for having me, Brian. Real pleasure.
Yeah, so it's good to see you again. So you've had this decades-long journey from traditional asset management and brokerage to early stage venture. What pulled you towards startups and private markets?
I would say it was pretty straightforward. Asset management is a bit lonely business. You spend a lot of time in front of the screens, analyzing technical analysis, a lot of boring days, and then you have some really unpredictable and almost unbelievable movements in the markets. Sometimes this happens, of course, when you're not in front of your screen. So that was one of the reasons. And the second one was I was really impressed when I got in contact with a couple of founders which were looking for some institutional capital. They asked me if I can help them with contacting and getting intros to potential investors. And I was kind of blown away with, the energy, the ideas. It was about time when blockchain was like really hot topic. Some very known ICOs, some projects that were really amazing.
We're not necessarily a blockchain startup, so maybe you could give us the 100 level. What's an ICO?
It's initial coin offering. So it's similar like IPO, but basically you can sell your coins or tokens without any real obligation to the investors. So this is a big difference, and a lot of them were purely scams and rug pulls, as they say.
So G plus Quant seems to function as a fundraising amplifier for startups. What do founders misunderstand about connecting with serious investors?
The most important thing is that they need to do their homework, meaning they need to really know how to professionally present themselves. They have to prepare the pitch decks, the data rooms. They have to have some really meaningful traction or a very good team. So, 3 times exit in the past, working for some reputable startups or companies, being top of the team in some really known startups. This is a big plus. Otherwise, you have to really, really struggle to persuade potential investors to give you money. So I think the most important thing is really how to present yourself, prepare relevant data, nice presentation. It doesn't have to be fancy, but really well structured, and you have to know what makes investors tick. So this is something that it's, I would say, fairly hard for technical founders. The founders who are really into what they are building, and they could talk hours about their their startup, but they don't know how to sell themselves.
So you're a referral partner and scout for several VC funds across Europe and the US. What trends or founder behaviors make a startup stand out to you right now?
I would say, everybody's focused on AI. So without AI, I would say that investors are not really even thinking about screening or reviewing your pitch deck.
Yeah, it's interesting you say that because we do a lot of AI and, everybody's using AI. It's kind of like saying you used the internet in 1999. I'm finding lots of good deals that are not core AI because investors are kind of overlooking these really like core, really great investable deals. They're growing 4 or 5x year over year, and investors are just overlooking because they're looking for those like real home runs, those 10x, 20x opportunities. Yeah, what are your thoughts on that?
I agree with you. I would say that AI is really a game changer. I think it's a revolutionary technology that will really change how we do business and how industries will work in the future, especially in, I would say, fintech, anything related to agents. So wherever you can use AI, basically you don't need any employees anymore. Or from, I don't know, a team of 10, you can use one person and replace 9 others with AI agents. So
yeah, and that's just getting more powerful now. I mean, you have Grok 4, which has agents built in, where it kind of sends off an ensemble of agents and comes back with the best answer. So I think, we're sitting here recording this in mid 2025 for posterity purposes. If anybody's listening in the future,
yeah.
I think, the next year or two is going to be absolutely crazy. I think we just haven't hit limits to scale with test time compute, with agentic workflows. And I think we're going to see some like serious second and third order effects here. And I think we're already seeing it in early stage venture. I don't know if you've had any startups that you've helped, seed strap, where they raise that first little 500K round and then they never raise again because they're just so profitable and they can scale everything, all the operations of the company with AI. They, like you're just 3, 5, 10x more efficient depending on the function area. And so you just don't need as much capital to scale anymore. And that has serious ramifications for our industry. I'm wondering what you've seen out there and what kind of changes you've seen, especially the last few years.
Okay, let me go back to the startups that you mentioned that do not have AI. I think these deals will be great because they will be able to sell themselves or at least take capital at much lower valuations. So it's a kind of, Warren Buffett style of investing, a business that really makes money with no big effort and it can scale. But if you think from the investor's point of view, okay, I can get this much cheaper than, let's say, a year ago. But if I invest in AI company, I can get 10x, 100x, 1000x. And this potential will basically make an investors always go to the AI. I mean, in venture capital. For family office, for somebody who already has some entrepreneurial background or has a business that is already like 50, 100 years old, these kind of deals that you are mentioning are now really great opportunities. But for venture capital who's looking for, as much as fast return, I think AI is definitely an opportunity that they will not miss.
Well, and it's also gotten all the way to the extreme, which is like the CTO of OpenAI leaving and raising on a $10 billion valuation pre-product, pre-revenue, raising $2 billion. I mean, that's the extreme, right? And I think I think we'll look back and we'll go, wow, that was a little ridiculous.
I agree with you. I agree with you absolutely. But let's then move on. You said, what do I see as a future? I see that also these AI startups, who are now looking very interesting, maybe in 6 months, they will be obsolete with their product because it's based on existing OpenAI or Anthropic or Claude, and a new agentic startup with new AI, newer AI, faster AI, cheaper AI will make it obsolete. But if you think or look at the AI infrastructure, For some very niche products, I think there's a lot of opportunities. For example, we are now just signed an agreement with an AI, it's called Lexity AI, providing legal support. So something like Harvey, but I would say more advanced, already better with better.
I'm seeing like sub-vertical things, like, to build on when you're saying, like Harvey was one of the first big vertical AI legal kind of co-pilots, but now I'm seeing sub-verticals of AI within law, where we have a startup that basically, all these accident attorneys with the billboards on the side of the road, if you're in a crash, all this number kind of thing. Well, they get millions and millions of phone calls every year, and now AI can screen those, qualify those, and see if there's a case there. And so that's just an example of a subvertical that we recently invested in. Yeah, so that's interesting.
And the second part of your question about this really speedy scaling with almost virtually no cost.
Seed strapping.
Yeah. I was really impressed. Cursor, Cursor that like in 3 months came to, I think, 100 million ARR. I mean, with like a team of less than 10 people. That's amazing. That's something that like 2, 3, 5 years ago, nobody expected. So this is something that will increase and increase, and it will offer investors unprecedented returns. So, and it's only the beginning. So can you imagine what will happen in 5, 10 years from now?
Yeah.
I mean, that.
Well, yeah. I mean, you could be just sitting there and just have ideas of problems you want to solve, and just start talking to an army of AIs that can help you build anything you can imagine, right? And then you have the manifestation of that with robotics, right? Where now you can, the cost of labor falls to the marginal cost of producing, the nth robot. And we're definitely hitting a singularity, as Kurzweil would call it, of both cognition permeating society, but also kind of robots being able to, do the last mile of delivery of materials and building things in the real world. And yeah, it's an incredible time to be alive. You've worked with both family offices, institutional LPs. How did these capital sources differ in how they approach early stage investing or investing in venture funds?
I would say family offices are in a way more complicated because there's some emotional element.
Yeah, there's the old funny phrase I keep hearing, which is like, you've met one family office,
Exactly.
meaning they're all different.
And they are all different. They have all particularities, At the end of the day, everything depends on some person who is maybe an older guy, very conservative. Then you have the younger generation who are much more interested in
Only want to do blockchain, and yeah.
yes, and venture capital, and looking for some tools and startups to invest in. So I think this is something that really is particular for family offices. On the other hand, there's plenty of capital available, but you need that click. For LPs, I would say they are much more difficult to start conversation. They have much more rigorous due diligence. They are very, straight and want to have everything well presented. Everything has to be according to some standards. So I would say each of them is difficult to interact with, but you have to know the things, the little details, and you really have to be focused on those details, because one mistake, one wrong comment, something that you forgot to send, or it's not properly designed, it will immediately take you out of the deal.
Interesting. Maybe you could tell us a story about that, like something you've seen that's a very particular kind of risk or warning.
I would say it's for LPs. So let's say for emerging GPs or GPs who are raising second, maybe third fund, extremely important how you prepare your deck. Extremely important to be introduced. Cold mailing, I would say it doesn't work in that kind of relationship. I mean, you can send hundreds of emails, but probably you will not get even one reply.
I can vouch for that. Yeah, it doesn't work with that audience. You have to basically get an intro
and really be well prepared. And I would say for the generalists, if you're not like top tier fund with like 5, 6, 8 funds, and great track record. I think for generalist fund, it's no use to even try to raise fund one or fund two. You have to be really niche, specialized. You need to show that you're able to search and find the deals that nobody else is able, and that you have really, really great network, not only between or among the potential founders that you can invest in, but also with LPs. So it's a long, long, painful, trust building relationship building process.
Yeah, this is an interesting thing to flesh out for the audience here, which is the niche versus generalist approach. Because I would call like Team Ignite a focused generalist. So we're kind of somewhere in between. We're not so niche that like we only do AI platform layer stuff or something very specific like cybersecurity. There's whole venture funds, firms that only do cybersecurity and they're really good at it. And then on the other end, you have kind of the generalist player that we invest in anything, any stage. That would be like the most generalist. That'd be A16Z or Sequoia, right? They're multi-stage, big investors. They invest in pretty much anything. You name it, soup to nuts. And then you have kind of the folks in the middle like us, focus, on a particular stage sector geo, right? So that could be, for us, it's pre-seed and seed, B2B software, fintech AI marketplaces, globally. So kind of somewhat generalist geographically. Maybe you could, for the audience out there, and we have VCs listening, we have LPs listening, and we have founders listening. Maybe you could kind of highlight why it's challenging, especially for an emerging manager, to raise from family offices and especially institutional LPs when you have a generalist strategy versus a niche.
You're too broad, and there's a lot of competition. So I would say if I were an LP and hearing a pitch from GP, I wouldn't be able to really trust him that he will be better than Sequoia or Andreessen or NEA or any of those.
Yeah, any generalist fund. Yeah.
They're too big. They have great networks, great scouts, and they have plenty of capital. For them, 100 million plus or 500 million to invest.
Billions. Yeah. Yeah. I think Insight, I don't know for a fact, but I heard like Insight's pre-seed fund is $1 billion.
So if you think about raising, I don't know, 15, 20 million, like a generalist fund, I mean, it seems like, you don't have an edge. You really need to have an edge. Having an edge means that you are something extremely special, So this is something that I see, and from conversation that we have. I was also reading one interesting newsletter. I can't remember who it was. Maybe Eric Newcomer, just a couple of days ago. No, it was somebody else. Anyway, so he was talking to two emerging GPs and one experienced GP. The last one had no issue raising a billion fund. The first and the second one have issues raising their first fund below 50 million. And,
Yeah, because you don't have track record, right? So like if you're raising your first fund, you have to almost be a specialist because you got to have an edge. But after you get to like fund 3 or 4, now the LPs can go, okay, well, how did funds 1, 2, and 3 do? And let me compare that to my others in my portfolio and see how you're tracking, right? And now you can kind of lean on your track record a little bit. And this is something we struggled with. I mean, our first fund was a YC focused fund. So that's a niche fund. It's like we're going after YC deals in their demo day. LPs understand it. It's a small little rolling fund, and it was like $1 million, right? Like nothing. And then our second fund, we did a generalist kind of seed fund, B2B software AI, of course, fintech marketplaces. And that took 2.5 years to raise. Now, granted, that was in 23, 24, and late 22. So, a couple of the toughest fundraising years probably in, 15 years. But yet, it was hard, right? Because you're trying to convince LPs what's your edge, what gives you the right to win. So like maybe we could go through for an emerging manager how they need to communicate those different things. Like you said, deal flow is important. Like why do you have unique access to deal flow? And then another one would be, can you win those deals? Can you actually get on the cap tables? And what else? What else is important, you think?
I would say the third thing, how you present yourself. So through the deck, so fund deck.
So that's just the overall like brand quality, star quality coming through the deck. Like, can you communicate this clearly?
Exactly.
Does it look polished? Have you done your homework?
Exactly. And it has to be really appealing to make a potential LP interested. Not too much of text, everybody likes to explain a lot.
Yeah. And they end up with 40 or 50 slides, and it's just like, it's just diarrhea of the slide.
Exactly. I think from my point of view, 15 pages is max. You can do it in 12 to 13, but let's say 15, and maybe you have an appendix, 2, 3 pages to have some really data or something that you want to emphasize, like, I don't know, potential 2, 3 deals that you did as an angel investor. But definitely track record. You have to show some track record. It doesn't have to be, if you are raising fund one, of course, you cannot show nothing but as an angel investor. And if you can find good deals as an angel investor, probably you don't have any issues doing it with a little bit more money or capital available. These 2, 3 things, I think, are really the most important. And if you have somebody who can recommend you, a big investor that worked with you, or somebody in your network who is, let's say, I don't know, a manager in some pension fund, or LP, has invested in venture funds before, so it can give you some valuable recommendation. I mean, warm intros are now the most important.
Yeah, it's the most important thing. Yeah. So how should an LP kind of evaluate, as you kind of get into, fund 2, 3, and 4? One of the things I've heard, maybe you could comment on this because you've seen a lot of funds raising and you helped a lot of institutionals on the other side. I've heard it's harder to raise a $30 to $50 million fund, call it fund 2 or 3, than it is just to go all the way to 100. Why is that? What is the kind of, how does, institutional LPs think about deploying capital into venture? And is it a check size problem where, like, okay, it's, you raise a $5 or $10 million fund, you get a lot of little 100K, 200K checks, and you can kind of fill that fund up. But it's harder to kind of fill a $30 to $50 million fund versus just going to 100 million and maybe getting $5 and $10 million checks. Maybe you could walk us through kind of how institutional LPs approach these emerging managers and at what size they kind of get interested.
Well, in partnership with Alpha Q Venture Capital, it's a fund of funds, and also a manager operator of GPLP invite-only platform called Discovery platform, working currently with 120 VCs, with a 3 to 5% conversion at the moment. And based on the statistics, we see that in majority funds who are now raising, or GPs who are now raising fund 3 or later, and with about targeted AUM 50 to 150 million, are kind of the most successful at the moment. Very niche, very focused. And I would say this is something that appeals to family offices, international family offices, high net worth individuals, and also to, let's say, institutional investors, but bigger family offices.
So that's interesting. Why do you think that is? Why do you think that kind of sweet spot between 50 and 150 on your third fund is the most successful?
I'm not sure, to be honest. I will tell you, I'm not sure. I think that everybody is trying to squeeze into those pre-seed, seed, Series A deals. Funds with this capitalization or assets under management, I would think that they are the most nimble. So they have enough capital to invest in good deals. They have good networks. They have enough follow-up capital. And I would say probably they do not have too high fees.
Well, isn't just 2% kind of typical? It's just 2% a year.
Yes, it is, but there has been quite a lot of writing lately about change or potential changes for fee structures, especially LPs are looking for better deals, and everybody is looking for, return of capital. All the LPs are waiting to get some portion of their money back, which at the moment, not a lot of GPs are really able or willing to do.
What kind of creative carry and fee structure have you seen out there that LPs are liking or VCs are going to market with that's successful?
I didn't see any big changes, but I would say that there have been some negotiations about maybe same carry, but lower management fee.
Yeah. And I think that would be aligned with what's happening with AI and startups, right? If startups need less capital, then it kind of stands to reason that, maybe VCs need less management fees. You're seeing some interesting negotiations. Like typically, what have you seen are, these GPs, these $100 million funds saying, maybe I don't need 2% a year to run this fund anymore. I don't need $2 million a year. And LPs are like, yeah, you don't need $2 million a year. So like, what are you kind of seeing in the market?
I see that, everybody's looking a way to save some of the costs that they have with potential investment. 220 has been, I don't know, a standard for a long time, even
Decades.
in
Yeah.
asset management as well. Then you have this kind of specialty funds that can even charge 30% of the carry. You have some hedge funds who have no problems, and customers pay them 30-40% on their returns, but these are really exceptional ones, exceptional returns and exceptional managers. I would say that, as far as capital is scarce, you're in control if you have it and you can allocate it. So, why not try to get a better deal? The competition is huge. There are thousands and thousands of VC funds, a lot of, I would say, established or known funds have lost team members who are creating their own VCs, trying to go their own ways. And this is something that really makes an LP, puts an LP in a position to, why not? Let's try to negotiate better deals. And the bigger you are, more capital you are able to provide, it's better your negotiation points or arguments are stronger.
Yeah, it's interesting, right? I mean, we talked about seed strapping earlier, founders and startup teams needing less capital than ever to scale. And you're certainly seeing, startups, raise a pre-seed and never raise again. So maybe on the same vein, venture capital firms are becoming more efficient and they just don't need the 2% anymore, right? Maybe it's attractive to go out to an LP and say, hey, we have AI and agents running under the hood helping us be more capital efficient. And, we're going to raise $100 million fund, but maybe we're not going to take 2%. Maybe we take 1.5 or one and a quarter. And do you think that's attractive to LPs? Because now they're calculating like, well, what that means is effectively you're going to have, 10% more capital over the life of the fund.
Exactly.
To go take more shots on goal, go follow on your winners, and potentially drive more returns.
Absolutely. I know you had Fred from Track, TRAC, on your podcast.
Yeah, Fred. Yep.
So
Yep.
I've been in contact with his colleague Joe for some time, and we are discussing this. They built basically an algorithmic VC fund. They do all of their due diligence through the platform, and my goal is to create something like special purpose investment company who is using 2 or 3 layers of AI to make a due diligence and do basically the whole investing process through AI agents and algorithms. So what do I need? I need just
Yeah, and we're doing the same thing at Team Ignite. Like you've seen the around X this past week, people posting their returns on option trading using O3 and Grok, getting 100 triple digit, 100, 150, 200% returns on option trading. Basically, they're just dumping all the data into O3 Pro, and saying, hey, like help me make these trades, and they're generating enormous returns. And I'm wondering if the same thing is going to happen in venture, right, where AI is kind of eating venture. And we're kind of already doing this at Team Ignite, not kind of, we are, where we run every deal on a pre-screening basis. Like should we talk to the startup or not? It helps us kind of filter all our deal flow. And then we run a post, kind of call it a post meeting. Hey, should we invest in this or not? And we have this, we're on version like 100 of our AI prompt using O3. And then we have a version of our prompt that we use for due diligence. And so in those 3 stages, it's AI under the hood. And my little story, you'll find interesting, is we used to hire MBA interns to come in and help us with the due diligence. That was like the part of the job that always bogged me down, like digging through the data room. And I'd have these MBA interns do it, dig through all the financials, dig through the incorporation docs. Here's the checklist. Here's like stuff to look for. And I'd always check their work, but it'd make me maybe 2x more efficient to have them take a first pass. But I realized, especially over the last, say, O3 has only been out since the beginning of the year, right? We're talking 6 months. I realized this past 6 months, that I can have O3 do this and it could do a better job than my MBA interns. So now I've shifted my MBA intern program to be more of a scout program. I'm like, I don't need you to help with due diligence anymore. I can do that with AI. I need you to go out in the community, go to demo days, go to startup events, go meet founders, and help me get more deal flow. That's, so it's becoming like this bottleneck. It's a kind of a, the bottlenecks are shifting in venture for me personally as a solo GP. From, it was around due diligence, and now it's really about fundraising and deal flow. And deal flow is like, we have incredible deal flow at Team Ignite. So it's not really a bottleneck, but you can always have more deal flow. You can always have better deals.
Exactly. And now think about all the costs that you had with MBA guys. AI is working 24/7, every day, every night, doesn't need holidays, doesn't have issues like health problems, family, nothing. So, from my point of view, in 2 or 3 years, VC funds with more than 3 to 5 people are useless. Why?
No, you just need people. You basically still need people to go meet founders, right? I think Mark Andreessen quipped recently that the last job to be automated will be a VC. I don't know if you agree, but like at some point you can imagine there's a solo GP with $100 million fund, probably me, someone like me, and there's others like me in the industry, and then there's solo founders, and so you got solo GPs back, writing $1 million pre-seed checks, and solo founders who have just AI under the hood. So they raise some money so they can pay for everything and maybe have some contractors or pay themselves a salary, and that's it. And it's just like it's one and done pre-seed investing.
Exactly. And it works.
It's a pretty wild world.
And it works. It really works. I mean, I just talked last week with one GP of a California-based fund, and we were discussing this. He was presenting me a co-investment offer, co-investment opportunity in Quant. It's a agentic AI platform. And I said, well, I'm just kind of trying to build this kind of, algorithmic structuring the deals, doing due diligence and everything. And he said, well, I'm completely against it. I said, I know, but you have a network. You have a network. You get deals through your network. You decide which deals to take by, discussing with the founder and with your partners. You basically have everything doing it in a human way. My idea is to completely the opposite. Automate as much as I can. Only discussion over a beer with the founder, I'll take it. Otherwise, I'll let the AI and the agents do everything else. So, from my point of view, I can be much more capital efficient, time efficient, energy efficient by using AI than taking the human way of doing the venture capital. But of course, his advantage is that he has this really valuable network, which I don't. And AI will help.
What's funny is most of my due diligence process now is just dragging files into O3 and giving it a prompt. Here are all the financial docs. You can only upload like 10 at a time, right? So here's all the financials and retention and IRR cube or, cohort analysis. You just drag it all in there. Take a look at this from a due diligence, and I have like 37 things in my due diligence checklist. Most of my due diligence is dragging things, letting it process, checking some emails, coming back 2 minutes later and seeing what it found. And then there's a yellow flag or a red flag here. Okay, let me dive in. And that used to be a 15, 30-minute conversation with my MBA interns, and now it's not. And so I think what you're saying is exactly right, which is automate everything you possibly can, right? And I haven't figured out how to automate this, file dragging thing into O3 yet, but I'm sure somebody will figure it out soon. I guess I could create an Airtable form where founders upload your incorporation docs here. And then I could have an API call from that file to O3 to check for yellow and red flags. Yeah, I could automate it right now, but I'd have to make founders kind of step through hoops. I don't have like I need like almost like an agent to crawl the data room, right? And kind of organize the files, upload it one at a time, and come back. But I mean, that's already here. I could probably make that now.
Yeah.
If I had time, or if I had somebody on the team that knew how to build agentic workflows, I could build that now. So like, what is the competitive advantage going forward if you have, people online generating triple digit returns on option trading, and you have solo GPs like me that we can all use AI, our own version of AI. We all, and I should walk you through what I've done on the AI front. It's pretty remarkable what I've been able to do with just hacking around with O3 and deep research. What is the competitive advantage? I think you're touching on it, which is like, what is your competitive advantage? It's like really your network, right? Can you get access to these deals? Do founders like you, and do they want you on the cap table? And then can you add value, right? Because everybody's going to have AI. It's all going to be super intelligent. SGI, AGI, like O5's coming, the new ChatGPT 5's coming. We're all going to have access to that. We're all going to be able to dump files in the data room and decide.
Yeah.
And
but this
yeah,
personal touch will give you an edge. Will be like a cherry on the cake. So if you know how to talk to founders, they need to like you at the end of the day. And
it's a sales job.
it's a sales job, exactly.
It really is.
And in a way, they will probably accept your money, but in the long run, if you have this human capital, which AI cannot provide or bring to the table, this will be that special element that will help you win deals. But saving time, saving costs, saving energy on all the processes that are involved in before getting to invest or write a check, I mean, this is really a game changer. I mean, if I just think about, get a lot of messages on LinkedIn, lots of inbound. Can I show you my pitch deck? Can you give me some feedback? We still have some allocation available. I mean, just going through all this and, screening 5, 10 decks per day instead of just, as you said, just throw them in the AI and, this is.
Well, and I've also back tested, right? Because Team Ignite's done hundreds of investments now over the last 6-7 years, including all my angel stuff before I had my syndicate and funds. So I'm able to go back, and every time I have a founder go out of business or shut down, which hasn't been that often, but the few times it happened, I go talk to the founder and we discuss like, hey, what did we get wrong about this business? Because we both believed in it. I invested and you spent years of your life, and you take that post-mortem and then you feed it back into the AI and it gives you better insights in the future of like what to look out for. And then the inverse is also true. When you have a startup that's really successful, then you try to dissect with AI, like, what did I get right about that? And then that feeds back into your deal screening process as you get these. And I get more than 5 or 10 a day. I probably get 30 a day, just cold inbound, 20 or 30 a day, from this podcast and from social media presence. And there's a ton, and I can't review everything, but I can have AI review it and tell me if it's good. And it does a really good job. It's gotten to the point now, because we're on like the 100th iteration of our screening prompt. We've literally gone through 100 of these, and we've just keep refining it. Oh, you missed this, you missed that. It's almost like you're training a human, right? Like I'm training like an MBA intern to deal screen, but it's an AI. Yeah. And now it's gotten to the point where it can prioritize it. And I'm pretty much always agreeing like, yeah, I should meet that founder, or I shouldn't meet that founder. I'm kind of, almost 100% aligned. Maybe it's 95% aligned with what I would actually think. And that's pretty incredible.
And it will get only better.
And exactly, it keeps getting 10x better every year.
That's the funny thing. I mean, it's getting better and better, and it will know more and understand more. I met with a really nice guy, Chris Combs, recently, and he's building a due diligence, or let's say venture capital platform, but from the founder's point of view. He's an ex-Google guy living in Slovenia as well, and he said, "Look, I screened and reviewed through my algorithm about 4,000 or 5,000 startups. A really small percentage of them you have a scale from 1 to 100. He said only a few got above 80, 85. So if you can imagine, you had to review 4,000, 5,000 pitch decks to find 3, maybe 5 really great opportunities. So if
I literally had, I have accelerators now. They invite me to demo day, and I'm like, I don't want to go sit through your 2-hour demo day. That's ridiculous. Send me all the pitch decks, and I'll have my AI process them and tell me which ones I should talk to, like literally. And yeah, so it's just making everything more efficient. But I guess on the flip side too, I mean, founders should be able to create better pitch decks with AI. They should be able to get more traction with AI, find better product market fit faster with AI. So it's not only going to accelerate the VC, but it should accelerate the founding teams as well.
Absolutely. And if you think that you need a marketing, a sales team, I mean, when you can automate all this, cold outreach, CRM integration, response, 3, 4, 5 emails, that follow up, getting the leads from LinkedIn, you can automate everything. I have a colleague. He said his wife and him are running a marketing agency. There are only two of them. Their competition are marketing agencies with 10 to 15 employees. But he's really started using AI very, very, very soon, very early. And he said, look, it works. For us, it really works. It works perfectly.
Yeah, I want to revisit the fee structure conversation from an LP perspective. Imagine you're going out and you're raising a fund, you're pitching LPs. What's the trade-off between management fee and carry, you think, in their mind? Like if you come in and you're at 2 and 20 versus 1.5 and 25, call it. Would that be like attractive enough of a management fee reduction for the increase in carry? Like, what do you think is the formula here for the point-to-point trade-off between fees and carry, if there is one?
I would say maybe not really the numbers, but how you will be able to repay the capital. When will you make some of the redemptions? How fast are you able to strike a deal to get some performance or return and then sell? Nobody's selling in venture capital.
This is a big problem. And yeah.
You have your holdings. When you are an asset manager, always need to rebalance. You have to keep your portfolio balanced. So if you see that some of your holdings are really doing well, you sell part of it. You see that you are losing, cut the losers. And this is something that I don't see in venture capital.
Well, yeah, there's illiquidity, especially at the early stages. I guess, as a pre-seed investor, pre-seed and seed, if they're losing, they can't sell it. You're left holding the bag and hopefully you get some capital back when they shut down. And then if you have winners, this is the delicate dance, right? Because you kind of want to let your winners ride, right? And let's say you're sitting on 100x, just for easy math. You got it in a 10 cap, ignoring dilution. Let's say it's $1 billion. Or 2 billion with dilution. So you're sitting on 100x, and how much of that should you sell, right? You're now sitting on a Series C, D, E opportunity. It's year 7 of your fund, and you got basically a fund returner here. For us, we do about 100, 150 a fund, so more or less returns the fund. Should we sell our entire position and say, hey, guess what? You got 1x DPI now, and or like, do you go, okay, well, this company's still growing like crazy. They could be the next Figma. I just wrote an article on the Figma S1, and maybe if I sell now at $1 billion, I miss out on 100x being a 2000x. How do you kind of balance that?
I think there are a couple of factors here. The one is you can always sell 10 or 25%, anything between this. So 10 to 25% you can sell, get some money back, and pay to your LPs. They always love the GPs who pay them back, before the fund ends.
Because it's kind of unexpected in a venture fund, right? Like, oh, I'm sitting in this pre-seed seed fund. I know it's 10 to 15, maybe even 20 years by the time this whole thing's wrapped up. I know it's really long term, and I'm sitting in year 6, 7, 8, and all of a sudden I'm 1x DPI. Wow, that feels pretty good. And then the TVPI might be 6, 7, 8x at that point.
Exactly. If you are thinking about raising your next fund, it's really wise and very well accepted from LPs to pay them some part of the money that they invested.
So you kind of liquidate some of your position. Like, let's say you had a $30 million fund and you're going out to raise a $100 million fund. If you return 1x, you just put $30 million back into the pockets of all your LPs, and you can go back and say, hey, guess what? I'm raising a $100 million fund. And they're like, great.
Exactly. How much?
You just made me whole on my investment, and you still have all the upside, right?
Exactly. So I think it's a kind of, a strategy game. What do you want to achieve? If you want to keep running on the management fee, then, you don't care. I'll wait for 7, 8, 10 years and I'll keep living on my management fee and I don't care if I will be able to raise another fund. But if you think strategically, okay, I want to raise in 5 years second fund and in next 5 years the third fund, then it's wise. Okay, I got here a really good profit. I'll sell 10, 25, 30%, maybe 50% of this holding. Or, attract a new investor by selling part of the holding already and then pay the existing investor, so make a rotation. So I think this is something that's worth exploring. But as I said, I was kind of very interested in secondaries because secondaries are a way to liquidity with no non-functioning IPO market. And it's something that it's really like a trader's game. You can buy shares, sell shares, like OTC trading, a very similar thing. So I think the secondaries are really a good potential.
It's really good advice. So from your vantage point in Europe, how would you compare the European early stage ecosystem to the US, especially, post the 2023 reset?
I would say that there are a couple of things worth mentioning. So in US, capital is abundant. I mean, there's really no issues with getting early stage funding or late stage funding if you are a great startup, if you're a great founder. The second thing I would mention is for later stages, European VCs are not big enough to be able to provide enough capital for growth like Series C or Series D. So we still see a lot of intentions by growth capital searching startups transferring to US, especially I would say for Israel. Israeli companies are going to US. They don't have even slightest idea or intention to go to London or Frankfurt or Paris. So this is another thing. The third thing is the European venture capital ecosystem is fragmented. You have the Nordics part, you have the DACH, German speaking region, you have France, you have UK, which is kind of a bridge between US and European Union. And I would say also that very much more conservative and risk averse. The European investor is, struggling with innovation. I think deep tech, for example, is maybe more anchored in the European ecosystem, while AI, for the time being, much more in the US ecosystem. But for climate sector is for me kind of tricky because everybody's talking about climate changes and we have to do this and we have to reduce the CO2, etc., etc. But in a way, I don't see very much, at least from my investor network, very much interest to invest in climate startup.
We're in a climate investing winter.
Yeah, I don't know why, but this is something I would say that maybe path to profitability and making really good returns on climate startups. I haven't seen it. Although there were some statistical research that ESG investments are almost more profitable than traditional investments, but I haven't seen it in real life from my perspective.
Yeah, I think it's a little bit of the average versus what's on the ground. You still consult high net worth family offices and run one yourself. But what are you advising clients to watch out for in the next 12 to 18 months? So around AI, rate volatility, private equity, secondaries, kind of what's your crystal ball?
Well, a lot of things changes day by day or week by week when we see, Trump policies coming out on through social or just being published on some of his tweets. So I would say everything is very unpredictable. Geopolitics is a big issue. I was just talking with my partners, or I was communicating with my partners at Fund of Fund and discussing potential investment in 4 VCs. Two are based in, one is based in Israel, one is based in UK, two are based in US. And from what I got as a reply is, look, there's no hurry. We'll wait. We don't see any issues waiting for maybe 2-3 months and then decide. If we need to wait more, we'll wait more. So I would say there's no hurry. On the other hand, you can miss a lot of good opportunities because, as we talked before, I mean, AI will really make some exceptional returns if you know where to invest and what time. I mean, I would probably not invest in Murati's 2 billion seed round.
2 billion on 10 billion pre-product pre-revenue.
I mean, this is something that I would never do or never recommend. But
somebody did it.
But for example, this Lexity that I mentioned before, a legal AI platform, I think this is something that it's really worth investing in at this moment. Or Track is now.
I'm very bullish on vertical SaaS and AI. I always have been, because there's just only so much horizontal platforms can do. Just kind of like, you look back at the history of technology, the Windows operating system, they couldn't build every application, that sits on top of Windows. And Google can't build every application that sits on top of, the browser. And OpenAI is not going to build every application that sits on top of AI. You're just going to have the human element in there, looking at the vertical use cases, vertically integrating and building applications, with agents and AI. And it's cliche, but you just look for the right team, traction, and timing. And I think you're just looking for execution now. What's your edge? In the same way that we're talking about how LPs evaluate VCs, VCs are evaluating founders, and we're kind of looking for the same thing. What's your edge? What's your distribution? Why you're the right team, right time, all that stuff. Let's wrap up with a quick rapid fire. Back to Europe versus US. What's one thing that European VCs are getting right that US VCs aren't?
I would say investing at lower valuations, maybe because the capital is more scarce. They need to be more, I would say, attentive to detail, and you don't have such a big pool of really good founders, or let's say exceptional founders, like you have currently in the US.
What's the most overrated fundraising tactic right now?
I would say use investor updates. Use investor updates.
That's overrated?
No, underrated.
Or underrated?
Sorry.
That's underrated. Okay. Yeah.
You are asking about overrated.
I was saying overrated, but yeah, underrated. I agree. Investor updates are very important. Yeah.
Overrated, I would say getting warm intro to potential investor without good preparation, and knowing that this investor really has intention or is willing to invest based on his thesis or investment criteria. So, expecting that if you get connected to investor, that he will give you the money. I think this is something that's really a wrong perception at the moment from the founders and GPs as well.
What's a startup sector you're seeing too many pitch decks in right now?
I would say everything connected to AI, but on this very basic level, in the sense that, we built something on top of OpenAI or ChatGPT, and we think this is really something that works, and it will work for 2-3 months, and then somebody else will come and make the same thing, as I said, much easier, much more efficient.
Yeah, that's why the speed of execution matters so much, because everybody can go build on top of OpenAI very easily. Eventually, you do probably fine-tune your own custom models and have your own data moat, but it all comes down to speed, just speed and execution, getting that data and creating a moat. I think the only moat is speed and execution anymore. Like if you're just shipping a lot and really being responsive to your customers, and you're acquiring customers at a very easy, cost-effective manner, you have a distribution wedge. I mean, that just compounds over time, right? And it's cliche, but that's kind of what we're looking for as investors: is speed, execution, traction. What's your favorite under the radar LP conference or community?
To be honest, I don't attend them. Since Corona started, I kind of completely stopped going to any big events, and hearing from colleagues that go and attend them, they say, for example, there was this EU startup conference in Malta recently, and a colleague told me that he was there, and all the VCs are basically not looking for potential deals, but are just looking for LPs. So, and if you come to an LP conference, there are maybe a couple of LPs, and all the others are just GPs who are looking for potential investor. So I think it's a crowded event that too expensive for the result that you get at the end.
100%. I don't like going to events. The only time I like to go is if I'm a speaker. And then I figure out, okay, I'm speaking Thursday at 2 p.m. Cool. I'm going to fly in Thursday morning, do my talk, and fly home Thursday evening. Like, I don't want to hang out. That being said, we are going to create an unconference for Team Ignite called Club Ignite. So a little plug there. Look for information coming. I got to launch it in the next month. It's going to be first weekend of November, and there's no agenda other than dinner and activities. There's no speakers. There's no ballrooms. There's no coffee in the hallway. It's just I don't know how many people we're going to have. We'll probably have a few dozen, maybe 50 to 100 people at a resort in Cancun, just hanging out.
Okay.
So it'll be a lot of the Team Ignite founders, Ps, partners, our fellow VCs that we co-invest with and follow on with. So it should be a fun conference, but it's not going to be like a conference where there's some like agenda and you have to go to a ballroom and sit at a round table and like listen to people talk on stage. And I don't like those conferences. I just want to go like hang out with people and play pickleball and stuff.
I agree. Social than professional.
Yeah, it's almost not even professional. And this is really inspired because I went to one of these in January at a ski resort with another venture capital friend of mine. It runs a VC firm. And I was like, this is the best, right? Because we're all just hanging out, skiing and snowboarding all day, sit in the hot tub having beer and going to have dinner together and then going to the bar afterwards. And that was every day for like 3 days. I was like, that's what people want. People don't want, like, I want to learn something. I'll listen to a podcast or a YouTube video or read a book. I don't need to go like fly somewhere to like learn things. That's all available online. I want to fly and just talk to people and hang out with people and do fun things.
And pay $5,000 just to attend for 2-day conference.
No, I'm not going to charge any money. I'm just going to name a place. There's no cost to attend if you're allowed in, and I'm gonna gate it. Not everybody can come. Like I'm just try to keep a good tight group of people. But I say that because tens of thousands of people like listen to this podcast and stuff. So we'll see. But it would be hard to. Maybe I'll use AI to screen the applications. But no, it'll be at an all inclusive resort, and then the people who want to come, like you pay the $500 a day or whatever it is to go to the all inclusive resort, so you get everything included, all the drinks, all the meals, all the activities. And then we have a WhatsApp group, and then we just have like, hey, we're going to play volleyball at 11, and we're going to play water polo at 2, and we'll play beach volleyball at 4, and we're going to have dinner at 6 here at this restaurant. And it'll be that loose. And you don't want to play pickleball? Like some people are playing tennis at the same time, so you can go do that. And that's it.
Sounds good.
Right?
Yeah. More like a gathering and party.
It's more like a vacation than a conference. Right. I was debating, maybe I can get your thoughts on this because I got 9 more minutes of your time here. Do you do it over the weekend or do you do it during the weekday?
I would say end of the week, like Thursday, Friday.
Yep. That's what I was thinking too. You kind of fly in on a Thursday or a Friday and then you stay out like Monday-ish. So it kind of bookends your week. Yeah.
And it still depends what age group are you targeting. If they have small kids and fresh wives, they don't like.
So here's the other thing. Well, here's what I'd love to get your opinion on this too. I haven't asked that many people about this, but I think I'm going to do an adult only, all inclusive. So there are no kids, right? If people start bringing their kids, then they have to focus on their kids and they can't just focus on having fun, right? Yeah. So it'd probably be an adult only, all inclusive resort somewhere on in the Caribbean. So it's really easy for people in Europe and East Coast to come. I'm on the West Coast. Yeah. Should be fun. So look for that invite.
Good luck.
Everybody that's been on the podcast will get the invite, right? So a few more questions. So LPs today, more curious, more cautious, or more confused?
More cautious.
Why do you think that is? Is it just that you can get 4 or 5% in your money market, and so you're just going to kind of wait?
This is one of the reasons. I would say also the macroeconomic factors. What's going to happen in 1 year? Predictability of financial markets is almost non-existing because all the models are broken. Maybe AI will help us with that, but you never know when Israel or Trump will send some bombs or rockets Taiwan is an issue. Ukraine is an issue. Gaza is an issue. So we're not really sure if things will come down or will escalate. Houthis bombed a couple of ships last week. So I don't know if we get some terrorist attack in Paris or in New York. This is not something that will help venture capital or LPs to allocate more money.
Right. Yeah, you need economic, political stability and low rates.
And inflation and interest rates. This is something that's not been talked a lot lately. Maybe it's something that really.
Well, the inflation print for the U.S. most recently was like 0.8%. So, and then we also ran a surplus in June because of the tariffs, which is crazy. And so now everybody's like, oh, wow. So maybe the Fed's going to lower rates, which should juice up venture, because the lower the rates, the more LPs become a little more risk on, because you have to, that's why 2021 was such a crazy time. Basically ZIRP. And so LPs are really seeking out anything that can give them returns.
Exactly. And now if you think that you could invest in US bonds and get like 4 or 5% per year, I mean, for an allocator, this is like, heaven, basically no risk for 4 or 5%.
Well, especially if you're sitting on billions of dollars at a family office or institution, right? You got all these, if you can get risk-free 4 or 5%, that's a ton of money coming in. Well, this has been a great episode. Where can folks find you online?
LinkedIn. I have my email published as well. So I would rather accept or receive an email than LinkedIn messages. I got
LinkedIn messages are such a black hole. Yeah.
So yeah, feel free to shoot me an email. I'll be more than happy to answer if it's relevant. If it's not, please don't blame me. I have too many emails per day. So if something is not relevant, I just delete it. So maybe try once or two times to remind me. But yeah, if it's not relevant, I don't have time to answer it. Unfortunately, I'm sorry.
That's the life. I know the life. But thanks so much for coming on, Damir. It was great.
Brian, it was great. Thank you for having me, and looking forward to have more conversations like this in the future and to do some deals together.
Yeah, absolutely.
Take care.